Okay, welcome back to the course Project Management and Finance. Now, as we have completed the unit number 1, 2, and 3, today we will approach to the unit number 4. So, some points from the unit number 4 has already been covered, but as per the request from the students, again I'm going to cover a few points from the unit number 4. So, today we will see unit number 4, that is financial management. Now, these are the content what we covered in the last lectures. First point is the function of personal management, operating budget, principle of good personal policy, introduction to financial management. And under this introduction to financial management, also we see the types of capitals. Now we will see again in the details. So, what is meant by the financial management and what are the types of the capitals? Now let's start with what is meant by the introduction. What is meant by the financial management? So financial management is nothing but simply the involvement of involving the uh, function of the management. That means of planning, organizing, and controlling the financial resources to achieve the organization goals. Hmm. So in the first unit already we have been studied about the planning, organizing, and function of management. So whole this planning, organizing, controlling, staffing, all are coming under the financial management as well. So based on that, so we have to achieve the organization goals. So some of the key areas of the financial management, so that are nothing but capital management. The second is investment decision, and third is financial planning and analysis. So these areas of the financial management are playing the very important role to achieve the organizational goal through the financial management. Okay. So here I have mentioned one the case study regarding the Apple's financial management. So Apple is known for its own effective financial management. The company always carefully manages its capital, makes the strategy investment decisions, and conduct the thorough financial planning to maintain its position as one of the most profitable companies in the world. So next, coming to the capital of types of capital. So what do you mean by the capital first of all? Capital, this is referred to the financial resources used to fund a business. So there are different types of capitals that are nothing but equity capital, debt capital, working capital, venture capital, retained earning, angel investment, mezzanine capital. So these are the types of the capitals. We will see one by one. The first is nothing but equity capital. So this capital is nothing but this is a fund raised by issuing the shares to investors. Okay. So there's the advantage of that nothing but there is no any obligation to repay the fund and no interest is to pay. That is called it as equity capital. So what is the disadvantage? Disadvantage is nothing but issue that there is a issuing shares the dilutes ownership and profit shared with the shareholders. So this is the disadvantage of this equity capital. Now here again I mentioned the one of the case study with the Tesla. Tesla has raised the significant equity capital by issuing the shares to investors and allowing the company to fund its growth and innovation. So next is debt capital. So this fund is this capital is the fund raised through loans and bonds. loans and bonds. Sometimes you can say the fund raised by the selling the ownership stakes. Okay. So what is the advantage of it? The advantages of nothing but the company retains the full ownership here, and interest payment are tax deductible. So there is no any taxable interest here. No. So second is next is the disadvantages. So what is the disadvantage? That there is an obligation to repay the principal and interest. So both have to principal and interest, which can strain cash flow. Okay. So here you can take the case study of the Apple. So Apple has used a debt capital by issuing bonds to raise the funds for its operation and share the buybacks. Okay. Now third capital is called it as working capital. So this is the fund used for day-to-day operation. So calculated as you can calculate that working capital is nothing but current assets minus current liabilities. So it has a importance because it ensures the smooth operation and helps to meet the short term obligation. So here you can take the case study of the Walmart. So Walmart's working capital management. So Walmart effectively manages its working capital to ensure it can meet its operation needs and maintain the liquidity. Next is venture capital. So what is a venture capital? Venture capital this is the fund provided by the investor for startup and high growth companies. So the advantage of that is nothing but startup gain access to expertise and mentorship with no repayment obligation. So that is called it as venture capital. So if you are taking the capital or the in terms of fund, or fund is provided by the investor, that you should not be a repayment to them. So this is one of them kind of the advantage. So what is the disadvantage? So investors often require a significant equity stake and have high expectation for growth. So here you can take the case study of the Uber. So Uber raised the billions of dollars from the venture capitals to fund its rapid expansion. Obvious. So next is retained earning. That is one of the capital. So what is it mean by the retained earning? These are the profits reinvested in the business instead of being distributed as dividends. So obvious, this is nothing but if you're getting the profits from the business, so same profit you have to reinvest for the business instead of being the distributed as a dividend. So what is the advantage? So there is no any cost of the capital, so no dilution of the ownership also. And that has the disadvantage of the amount is limited to available profits, and there is an opportunity cost of not not distributing the dividends. So for example, the Amazon reinvests a significant portion of its profits into new projects and innovations and driving its long-term growth. Next is angel investment. See, actually, angel this term is for the investors for the individual investors that are called as angels. So, what is mean by the angel investment? Angel investment is nothing but this is the fund. This is the fund provided by the individual investors to start up. So it has the advantage of angel investors often they provide flexible terms and valuable mentorship. And also it has the disadvantage. So the fund amount is usually limited and startup may lose the equity. You can take the case study of the Facebook. So Facebook received the early funding from the angel investors like Peter Thiel, which helped the company grow in its initial stages. Next is mezzanine capital. So this is the hybrid of debt and equity financing, mm, and often used for the expansion of the business. So it has the advantage offers the flexible repayment terms and less dilution than equity financing. And also it has the disadvantage. So disadvantage are nothing but having the higher interest rates and also having the potential equity conversion. So for example, you can take here the Starbucks mezzanine financing. So Starbucks used mezzanine financing to fund its expansion into new market. So these are nothing but the types of capitals. Now coming to the source of finance. So what is meant by the source of finance? Obvious that if you want to grow your business, if you want to do the development for their business, obvious that you need the financial support, and that financial supports can be get it from the kind of sources. So that are there are the two classification of the sources. First is the internal source, and second is the external source. So as the definition, you can define the financial source of finance. That is nothing but sources of finance refer to various ways in which a business raise fund for its activities. So obvious that the if you are looking in perception of what are the importance of the source of finance, the first is it requires at it's essential for starting the business, uh, running the business, and expanding the business. So in three kind of we need the support financially. So we have to find the sources of the finance. So as here mentioned, there are the two classifications: internal sources and external sources. So let's see the details of the sources, as like here mentioned, internal sources and external sources. So first we will look into the internal source of the finance. So here the first internal source, that is called it as retained earning. Retained earning. This retained earning is nothing but the getting the profits from the business, and the same profit is reinvested into the business. So that is called it as retained earning. This is one of the internal source of finance. So obvious that if you have the business, what you are getting the profit, so some part of from the profit you have to reinvest for the expansion of the business or to run the business. So obvious that there is no any interest on the cost. So this is one of the return the earning or accumulated profits of the company that are reinvested rather than the distributed as a dividends. So there are the cost effective since they don't have any involved in the borrowing also. So second is sale of assets. Sale of assets in the sense it is the selling unused assets can generate the funds without increasing the liabilities, and it's suitability it's suitable when the business has the surplus assets. If you have this additional assets, so you can sell it and reuse the fund for the expansion and running the business. So this is one kind of the internal source of the finance. So third source is nothing but owner's capital. So name itself explaining a lot of things. So you can understand here that the owner's capital is nothing but the firm invested by the business owner. Hmm. So here the owner's capital represent the personal fund injected by the business owner, and usually at the start of the venture, or you can say at the start of the startup. Hmm. So obvious the advantage is that there is no any repayment obligation. Now second next is the external source of finance. So here again mentioned the three sources. One is share capital, second venture capital, third is crowdfunding. So first of all, the share capital. Obvious, every business is building with the shareholders, with the shares also. So in kind of the shares here, share capital in the sense raising the fund by issuing the shares. Raising the fund by issuing the yes. So share capital involves the issuing the equity shares to investors and providing the long-term capital without the obligation of repayment. So there again there is a no repayment, but having the permanent capitals, having the permanent capital. Yes. If you have the shares, so share are getting from the shares you are getting the funds. So that raising fund you have to use for the expansion and running of the business. So that is nothing but the that you are getting the capital is called permanent capital. Next second is venture capital. So venture capital invest in the high growth potential startups. Basically, it needs this capital needs when you're going to start with the startups. So that venture capitals has the investors are called it as the investors are investing the funds. So that are called it as venture capital. So it has the advantage that the expertise along with the funding. Mm. So you are getting the investors are one kind of the experts. So that experts also you are getting as expertise with along with their fundings. Mm. This is one kind of advantage, but disadvantage of the venture capital is nothing but that you will not get the much more funding from the venture capital. Next is the crowdfunding. The crowdfunding is becoming the increasingly popular because as it leverages the public support to raise the small amount from the large number of people. So that is so this obvious this is fund generated or raising from the more number of people. So that raise is that's why it is called as crowdfunding. So simply you can say the raising the small amounts from a large number of people. So what is the advantage of that? Advantage is nothing but access to people support. Hmm? Access to the people support. So this external source of funding or source of finance is in terms of equity. So in external source of the finance also available in terms of government and this government and the special activities. So that are nothing but the grants and subsidies. Second is leasing and hire purchase, and third is factoring. So grants and subsidies are the non-repayable funds provided by the government, often for the specific projects. So this is one of the major advantages that this is a non-repayable fund, which is provided by the government. Huh? Next is second, leasing and hire purchase. So in leasing allows the business to use the assets without purchasing them outright. Okay, and which is the cost effective for the equipment or the property. So this has the advantages of the lower upfront cost. They're having the lower upfront cost. And the last is factoring. So this is also one of the external source of finance under the category of the government and the special schemes. So that is factoring in the sense factoring which involves the selling the receivables to a finance company at a discount to improve the liquidity. So these are the external source of finance under the category of government and special schemes. Now coming to the next one, that is nothing but capital building. Capital building is a fundamental aspect of the financial planning and aimed at the accumulating the sufficient resources for the growth and the stability. Mhm. So first of all, we'll say that what is meant by the capital building. So capital building is the process. It, actually, it is a refer to the process to for of the accumulating the financial assets to support a company's long-term growth. It is a crucial because a company need a stable financial foundation to expand and innovate and sustain the operations. So, what is maybe what are the importance of the capital building? So, first is nothing but ensure the financial stability, and second is nothing but this supports the business expansion and the innovation. Obviously, without capital building, businesses may struggle during the financial downstreams or while planning for the major investments. So, what are the objectives of the capital buildings? Here I have enlisted the four objectives. The first is financial stability, second is business growth, third, risk mitigation, fourth, wealth maximization. The main objective of the capital building is to maintain the financial stability. Businesses needs enough fund to meet their daily operation and the future projects. So for that, the financial stability is playing a very important role. And second is the business growth. It also aims to drive the business growth and enabling the companies to invest in new ventures and maintain the competitive advantages. It means that if you want to obvious this business growth in the sense investing in new projects. So this capital building has the one of the objective that to business growth, which involves the investing in new projects and ventures. And third is risk mitigation. Additionally, the capital building helps the mitigate the risk by ensuring a financial fusion during the economic uncertainties. So having the resource to face the uncertainties. So in the business, number of hurdles you will get it, but you have to take the you have to face to the risk also. So to face the uncertainties, the capital buildings will support you to mitigate the risks. And then lastly, the wealth maximization. That is a process ultimately aims at the wealth maximization and increasing the shareholders' value through the smart financial practices. So obvious it will increase the or you can say enhancing the shareholder values. Now to build up the capital buildings, where there are the different strategies. So few strategies I have enlisted over here. The first is profitable operations. Second is strategic investment. Third is diversification, and fourth is debt management. Now, first strategy, that is profitable operations. That is to build the capital businesses focuses on the maintaining the profitable operations, and this involves the cutting necessary cost and optimizing the revenue streams. So this is one of the strategy, increasing the revenue and reducing the unnecessary expenses. Second, strategy investments. So investing in profitable assets and opportunities. So strategic investments are also crucial. Business need to invest wisely in assets or markets that promise good returns. And third is diversification of income. So in the diversification of income, that is another strategy to ensure the stability, reducing the dependency on a single revenue stream. So this is that involves the exploring new markets and the products. And the last is debt management. Efficient debt management is vital too, as minimizing the interest payment can save the significant amount of capital. So debt management is focusing on the interest, reducing the high interest. So that which can save the funds that will help to building the capital. Next is the there are the different methods of the capital building. One is nothing but retained earning. Second, issue of shares. Third, long-term loans. And fourth is strategic partnership. First, retained earnings. One of the most reliable methods is retaining earnings. Instead of distributing all profits as a dividends, business reinvest them into the operation or reserves. Obviously, simply, if you settle any of the business and you're getting the profits, that profits can be reinvested. So that is nothing but a retained earning. So that can be utilized instead of distributing all profits as a dividend. So you can reinvest into the business for the expansion or the operations. Hmm. So that is one of the method of the capital building. Next is second, issue of shares. So issuing shares is another way where companies raise the fund from stake shareholders from the shareholders and offering ownership in return. So that is one kind of raising the equity from the shareholders. Third is long-term loans. So long-term loans are also the common, especially when business needs the significant capital for expansion. So you can secure the debt with the manageable interest rates. Then you can build the capital as a capital building for the business running the business or expansion of the business. Next is a strategic partnership. So forming the strategic partnership helps in the pooling resources, reducing the individual financial burden also. So as like grouping, the number of strategic partnership in the sense the in the business have the partnership with the number of number of owners with the partnership, so that which can reduce the financial burden also. There are some against this method of the capital buildings have some challenges in the capital buildings. So here I have highlighting the 4 points of the four points related with the challenges in the capital building. First is market fluctuations. Second, high operational costs. Third, poor investment decisions. And fourth is inefficient debt management. So now in the capital build, now you can say here the capital building isn't work without the challenges. Uh, So market fluctuation can severely impact the cash flow. So especially for business reliant on the seasonal demand. The second is high operational cost. The high operational cost can drain the capital reserves quickly, making the management essentials. Third is third is poor investment decision. So poor investment decisions like venturing into unprofitable projects can lead to the capital erosion. So that is one of the challenge. And next is lastly it is of in, inefficient debt management. So lastly, inefficient debt management where loans with high interest are not managed properly, then it can significantly reduce the profits. So it has a challenge to the building the capital buildings here. So these are the points of the today's lecture. So if you have anything else, let me know. Thank you very much.